Hello everyone, I'm going to go over exam 2 with you guys, just a practice exam to practice with for the exam. If you have any questions, you can either email me or you can stop by my office hours. And if you can't make the office hours, we can set up a different time. If you're interested, just let me know. And so let's start with the exam. For the master budget is the problem 1. So we'll start with the short answer and then we'll go to the multiple choice. It says fine furniture manufacturers wooden tables. Management's preparing the budgets for June and accumulated the information. So it gives you the expected sales for June and then July, the selling price and direct materials. So for A, we're going to start with the sales budget for the month of June. And you're going to take your expected sales, which is the 2,000, which is given, and then you're going to put the selling price per unit, which is 250, and you're just going to multiply those together, which just gives you 500,000, and that's going to be what your sales budget looks like. And then for B, it says fine furniture does not have a work in process inventory since all the units are already completed on the same day. Then it gives you the ending finished goods inventory maintained at 5% of these sales. And it just asks you to prepare a production budget. And it also says the beginning balance is 100 units. So for a production budget for June, you're going to take your sales, which is the 2,000 found in the question. Then you're going to add in your ending inventory. So for ending inventory, it's always going to be the next month's expected sales and then by the percentage of the expected sales. So it's going to be the 2,500, which is found where it says right here, the expected July sales, and then multiplied by the 5%, which is found in the question. So that gives you 125. And then you're just going to add those together. So that gives you 2125. Then you're going to subtract out your beginning inventory, which is given in the question for 100. That was in the hint. And then your total production budget is going to be 2025. And then for C, it's saying fine furniture is located near a lumber supply store, only purchases materials as they are needed in production. They do not carry the materials inventory. The company agreed to pay 60% of the cost in the period bought and the remainder in the period following. And the accounts payable balance at the beginning is 30,000. What is the amount budgeted to be paid in June for direct materials? So for this one, you actually start with the production, which was found in B. That's going to be the 2025. And then you're going to put in for the direct materials, and you're going to multiply that. That's going to be per unit, so you're going to multiply that by 40, and that 40 is going to be found right up here. So that's going to give you 81,000. That's going to be right down here. Sorry, it gets cut off because the page. All right, and then you're going to take the cost, which the cost is going to be times 0.5, which is going to be right here, the feet of lumber per unit. That's where the 0.5 comes from. So the 81,000 times 0.5 is just going to give you 40,500. And then from there, since it's saying that they agreed to pay the supplier 60% in that current period, you have to take 60% of that number. And so taking 60% gives you 24,300. And then also in the question, since it gives you the balance at the beginning in June, you have to just add that back in. So you're going to add the 30,000. So the total amount budgeted is going to be 54,300. All right. And then for problem 2, it's saying integrated manufacturing uses CVP tools to analyze overall costs. The total costs were 100,000, total sales were 105, and variable cost was 50 per unit, and the company sold 700 units this period. So first, we're going to look for the break-even point in units, and your break-even formula is going to be fixed cost divided by the contribution margin. And your fixed cost formula, since it's not given, is your total cost minus your variable cost. So looking for break even, you're gonna start with the 100,000, which is your total cost. And you're gonna subtract that, since we're still trying to find the fixed cost first. You're gonna subtract that by, since it doesn't give you the full variable cost, it only gives you the variable cost per unit. You have to take the variable cost per unit, which is 50, and multiply it by the units sold. So 50 times 700, and that the 100,000 minus that is going to give you 65,000. So that is going to be your fixed costs. And then your contribution margin formula is the sales minus the variable cost per unit, which is going to be, so sales per unit minus variable cost per unit. Put that in there. So to find the sales per unit, you're going to take the 105,000, which is your total sales found right up here. And you're going to divide that by the number of units sold. And then you're going to subtract out the variable cost per unit, which is given, which is 50. And that is going to give you 100. And just so you are aware, the sales per unit is 150. And then you are going to take the, since you're overall looking for the break even, now that we've found the fixed cost and the contribution margin, you take the fixed cost, which is the 65,000, and you're going to divide that by the contribution margin, which is this 100 right here. And that gives you 650 for the break even in units. And now to find the break even in dollars, you take the break even in dollars formula is the one, it's going to be the sales per unit multiplied by the break even per unit. So that is going to be the 150, which is the sales per unit, and then multiply it by the 650 where you just found, and that's going to give you 97,500. And now, how many units must the company sell in order to achieve before tax profit of 30,000? To find that, first, your target formula is going to be fixed cost plus your profit divided by the contribution margin per unit. So you're going to start your fixed costs. We found earlier the 65,000 from above, right there. And then you're going to add in your profit, which is 30,000, which is given in the question, and then divide it by your contribution margin per unit, which we also found up in A. That's going to give you 950. That's how many units you should sell. And now for D, we have to find out how many units to sell to achieve an after-tax profit. So the first one was before tax, this one's after tax of 13,000 with a marginal tax rate of 35%. So for this one, you are going to find first pre-tax. You have to find the 13,000 is the profit. Then you're going to divide it by the marginal tax rate, so 1 minus 0.35. And that's going to give you 20,000. That's going to be your pre-tax amount. And then to find the target for after tax, you take, very similar, you're going to take the 65,000, found your fixed costs, add in that 20,000 you just found with the profit and the tax rate added in, and divide it by your contribution margin per unit. And that gives you 850. All right. Now for problem 3, Fixie Carpet Manufacturing uses a process costing system, calculates per unit cost using the weighted average method. The following data relates to the first production department, the weaving department of its rayon carpet brand for the month of November. Note that since the carpet is sold by the square yard, each unit refers to the square yard of carpet. So the beginning WIP gives you 300 units with 40% complete. And then the ending WIP is 400 units with 25% complete. And it says all direct materials are added to the beginning of the process. Conversion costs are assumed throughout the production. The cost of direct materials in the beginning was $21,200. Conversion in beginning is $4,900. And then just says during the month, $110,800 of direct materials were added. Direct labor was $23,120. Overall allocated 25% of direct labor, and then 5,100 were completed and transferred. So first, to start for question 4, it says how many units were started in the weaving department during the month of November. So to find this, the formula is going to be the beginning amount, and then you add in the amount started and subtract out the ending, and that gives you what was completed. So we know the beginning of 300. That was found right here, the 300 units. We don't know the started, so we're just gonna leave that blank. And then you can subtract out the ending, which is 400, which is given right here. And then we know what was completed, which is the 5,100, which is found right here. It says completed and transferred. So just by doing basic math, you end up with 5,200. And that's going to be your answer for how many units were started. And then to find the amount of units that were in direct materials, you are going to take, so basically since you're doing 100% of the direct materials, you find the 5,100 is going to be the amount completed. And then you have to add in the ending inventory of 400. And that's going to give you the 5,500, and that's going to be the amount of direct materials produced. So this 5,100 is going to be the amount completed, and then you just add in the ending inventory, and that's going to give you the equivalent units of direct materials. And now for conversion costs, you have to take the direct materials, and you also have to take the direct labor. So for the conversion costs, since there's going to be 100% of the 5,100, there's what the 5,100 is the completed, which is what we used right here in 5 as well. And then you're going to have to take 25% of the 400. And the reason why you take the 25% is because it's only allocated 25% of the direct labor costs. So doing that, you're going to get the 5,100 plus 100, and that's going to give you 5,200 for your conversion costs. And then for number 7, you look at average costs. So for average cost, the formula is just going to be, you're going to use the 2,100 of beginning WIP, and then you're going to add in the 110,800, which is going to be right here, the direct materials. And you're going to divide that by the 5,500. Since looking for the direct materials is right here. And that's going to give you 24. Sorry about that. So that's going to be the answer for the average cost per equivalent unit of the direct materials. All right, so then we can move on to number 4, which is variable and absorption costing. So for A, so first, variable and absorption, Hellman Manufacturing has the following cost information available. So it gives you the direct materials, direct labor, variable manufacturing overhead, the selling and administrative costs, fixed and then manufacturing overhead and then fixed selling costs. And they produced 12,500 units out of the 11,000 that were sold for $60 each. So to find the variable cost, very easy. Basically, you're just going to take your DM plus your direct labor plus your variable manufacturing overhead. That's going to be 6 plus 4 plus 2. And that's going to give you 12. That's going to be the answer for the unit cost of variable costing. Then for absorption costing, you have to add in your fixed cost. So for variable costing, you do not include fixed cost, but for absorption costing, you do. So you're going to take the direct material, direct labor, plus variable manufacturing overhead. And then since it's absorption costing, you have to also include the fixed manufacturing overhead. So make sure you don't forget that on the exam, that absorption costing includes fixed, variable costing does not. So that's going to be 6 plus 4 plus 2 plus. To find the variable manufacturing overhead, since it only gives you the amount, it doesn't give you the per unit, you have to find the per unit. So you're going to take the 80,000, which is the amount that it gives you, and you're just going to divide it by the amount of units. And that's going to give you 18.4 is your final answer for absorption costing. And now to find out which method has a higher net income, basically you're just going to look at the two. So it's going to be, you're going to look at the 18.4 minus the 12, and that's going to be absorption versus variable. That gives you 6.4. It's going to be left in the absorption costing, or it's going to be left. And since the absorption costing is higher, that means it's going to be less expensive. So less expensive because absorption is higher. And that results in a higher net income. So absorption costing is going to be the way to go. And to find how much, you take the 12,000 and you are going to subtract it by the 11,000 units. And the 12 is going to be from right here. And that is going to give you 12,500 from right here. And just basically you're looking at right here, 12,500 minus 11,000, that gives you 1,500. And you're just going to multiply it by the 6.4 that we just found up here. And that is going to give you 9,600. That's going to be about how much higher it is. All right, so now we'll go back up to multiple choice. So for number 1, which of the following is true regarding process costing? So the answer to this question is going to be C. Large volumes of homogeneous products are manufactured in continuous flow operation. The reason being is because when it says process costing, that means mass production. Where if it said job costing, that means it's just going to be an individual job or order. For 2, which of the following best describes the weighted average during the cost flow assumption? The answer to this is just going to be D. So that's just the formula for weighted average cost per equivalent unit calculated by combining the costs from both the current and previous periods. For 3, which of the following is an example of a type of company that would most likely prefer a process costing system? That is going to be B, oil refining. The reason being is because in an oil refining, it's going to be a mass production just continuously going versus the other ones are more like specific products for one job. And then for 4, which of the following is not an example of a type of company that would likely prefer a process costing system? That's going to be home building. So for a home building, that's not going to be processed. That's going to be more job costing because it's going to be specific to that home, not something that's going to be continuous in a big mass production project. And then for 5, Pennington Products has 2 product lines, R100 and R200. Revenue and cost information for each are as follows. So it gives you the selling, the variable, and the fixed expenses. And it just asks what's the segment margin. So to find this, you are going to take the, let me see if it lets me type on this. All right, so you are going to take the difference between the 45 and the 15, and that is going to give you 30. And then that's the difference between the selling and the variable, obviously. And then you're going to multiply that by the units sold. So that's 30,000. Since you're looking for R100, that's why we're using that. That's going to give you 900,000. And then you just subtract that from the fixed expenses of 250,000. And then it's going to get you 650,000, which is A. Then for 6, Finley Company has its company headquarters based in Raleigh, North Carolina, has 6 individual retail stores spread throughout North Carolina and Virginia, which the following costs most likely treated as common costs for the reporting purposes. So it's going to be C, 3, the least cost for company headquarters. And the reason for this is because rent is always going to be considered a specific cost because it's not directly associated with any specific unit. For 7, at break-even point, this is just a formula. It's going to be A, contribution margin equals fixed costs. For 8, the company produces microprocessors for laptops. Last year, the company recognized the revenue of $4,000. Total costs for the period were $2,000, of which $1,500 were variable and the remaining $500 were fixed. What's the degree of operating leverage? So to find this, I'm just going to switch over here. First, you're going to do your sales minus variable. So that's going to be the 4,000 minus the 1,500. That's what you're always going to start with. It's going to be 2,500. Then you take the 2,500 and subtract out the fixed. It's going to be very similar to what we did in the other question. That gives you 2,000. And then you're going to take your 2,500 that you found with the sales minus the variable and subtract it or divide it by the 2,000 that we just found. And that gives you 1.25. That's going to be C. For 9, they produce microprocessors for laptops and they recognize revenues of 4,000. Contribution margin ratio is 0.6. The total fixed costs are 1,800. And what is the margin of safety? So to find the margin of safety, you start with your fixed costs. Let me switch back to here. Fixed costs of 1,800 and divide it by the contribution margin ratio of 0.6. That's going to give you 3,000. And then you have to just subtract out the revenues from there to find the amount that's going to be safe. So that's going to be the 4,000 minus 3,000. And that's going to give you 1,000. That's going to be A. Then for 10, which of the following statements is true regarding CVP analysis? So sorry, that was Professor Winter. And the amount true is going to be D. It's going to be useful in all types of business with any products or product mixes. Then for 11, in determining inventory costs, which of the following cost elements is included when using absorption costing, but excluded when using variable costing. So for this, fixed overhead, and I went over this in the short answer, so you do not include fixed in variable, you just include it in absorption. Then for 12, If the unit production exceeds unit sales, absorption is going to be more of the income. So that's also what we said in the short answer, when it's going to be a higher income. So when the production is going to be bigger than the sales, it results in more. And then for 13, variable costing may be used by management in preparing audited financial statements. This is going to be false. And absorption costing better upholds the matching principle. So it matches like the revenues with the expenses. And so that's why it's going to be better, because it's not going to be recognized in the same period as revenue if it's variable costing. And then lastly, for 14, which of the following is a drawback to absorption costing as opposed to variable? And that's going to be the managers can manipulate earnings by simply producing more in a period. So since it is taken at each period, it's possible that the managers can change it, or basically just producing more and then taking it in the same period. So that is all for the exam. If anyone wants me to send this to them, I can send a blank copy, or I can send the copy with all the answers on there, and just let me know. Like I said, just email me if you have any other questions. All right, good luck.